Hi guys, in this video we'll go over chapter 7, the production cost and industry structure. So this will be the very beginning of our 5-chapter theory on the different structure of the industries in the economy. Okay, so let's get started. So in this chapter, we're going to talk about the explicit, implicit cost, accounting, economic profit, and also production costs in the short run and long run. All right, so let's get some definition out of the way. So think about what is a firm. So firms are companies. So producer or business that gathers all the resources, so like your labor, land, and capital, and produce goods and services. That's called a firm. And then private enterprise, they're the private companies owned by individuals. So private enterprise can be anything as a public traded company or your local mom and pop shop that owns a bakery. But the opposite of private enterprise will be something like a government control enterprise, right? So imagine, let's say the school will be a public school that will not be a private enterprise. And also knows of production. So production is the process of combining input to produce output. That's called production. And you guys are going to hear this a lot in this chapter. So input, output. So input are the resources company need. Output are the productions company produce, right? So input is what's going to the company. Output is what's coming out of the production line. All right, so there are total 4 types of market structures. We have perfect competition, monopoly, monopolistic competition, and an oligopoly. We're going to be spending a chapter for each of these concepts in the next 4 chapters. So a perfect competition, you're going to see many companies selling the same good. A monopoly company or structure is the opposite side, where there's only one company selling a very unique good, and there's no competition for that one company. Monopolistic company is somewhere in the middle. So you have many companies, but everybody sells similar but not identical good. And lastly, oligopoly is when you have a few companies, so 2, 3, 4, 5, that sell similar or identical good. And what makes the oligopoly special is that because the market is so small, only dictated by a few companies, the action of one company will have impact on the well-being of other companies. Okay, so 4 structures here. We're going to be spending a chapter for each of these four structures later in the semester. All right, so also know what's a profit. So the goal for each company is to maximize profit. Profit is your revenue minus cost. Revenue are the income generated by the companies from selling the good. And then as a simpler form, your total revenue, the total money collected by the company will be just equal to the price of each item times how many items this company will sell. And also know the difference between explicit cost and an implicit cost. So explicit costs are the costs that really company are paying out of pocket, right? So directly. So wage, rent, utility, those would be explicit costs. Implicit costs are the opportunity cost the company has that's already in use in production. So for example, think about the time of the owner, right? Or maybe depreciation of your equipment capitals, right? So those will be implicit cost. So let's put in an example. Suppose I own a business, and suppose my business is producing chicken fried rice, and then my profit equals to how much money I'm collecting from my customers, right? So how many I can look at by each day how many order of chicken fried rice I sell, multiplied by how much each order is. That will give me my total revenue. That's how much money I'm collecting from my customers. Subtract my total cost, so the cost of wage, rent, utilities, and then maybe opportunity cost, and that will be my total profit. So there are 2 measurements for profit. They are called accounting profit, which is what you report to the government, what you use to report to pay taxes. So accounting profit is your total revenue minus explicit cost. So the cost you can actually measure in real term. Economic profit is your total revenue minus total cost, which include explicit and implicit cost. Now, again, implicit cost, that's your opportunity cost. So for everything you do, there's always opportunity cost. So therefore, that your economic profit is always less than your accounting profit because we have a positive implicit cost. All right, so next let's talk about production in the short run. But first we need to know what's a production function. So production function including all the input the company need to produce a good and service. So this input are also commonly known as resources. So for resources for company, so this textbook has 5 categories. We have natural resources, so land, raw material, labor, capital, technology, and entrepreneurship. Um, Now this capital here, this is only your physical capital, so equipment, tools, machines, uh, work, so those would be capital. But your financial capital, so like money and bond, that is not part of factor production. Okay, so this is very important because you might see a question on quiz about this, right? So factor productions only has your natural resources, labor, capital, technology, entrepreneurship, money, and then any other financial capital, they are not part of our factor productions. So the production function equals to, so the F here stands for function. So it's a function of natural resources, labor, capital, technology, and entrepreneurship. So we're listing each of this input here. At the end, we have our output, right? So production function shows you the input of the company versus the output for the company. All right, so some of the factors are fixed in the short run. So think about capitals. So how many, so imagine for my business, how big my building is. So the size of my factory, that is fixed, right? So that's not possible to change in the short run. But variables such as labor can change, right? So how many employees are hired in the company can change in a short span of time. I can hire more people or hire less people. So really your production function in the very simple form is just a function of your labor and capital. Remember, your capital is fixed in the short run. Labor is variable in the short run. So labor can change in the short span of time. Now, the difference between short run and long run, in the short run, you have some fixed variables. So as we mentioned before, capital is a fixed variable. In the long run, every factor become variable, become flexible. So in the long run, even the size of my building can be changed. So capitals can also be variable in the long run. So in the long run, you have no fixed variable. Okay, so again, fixed means it cannot change. Variable means you can change in a short span of time. All right, so because our capital is fixed, so in a very simple form, your total output, your Q, equals to your total product. So TP stands for total product. That measures the total production for the company, equals to a function of labor. So in the short run, how much you can produce really depends on how many workers you're gonna hire because our capital is fixed. Also known as a marginal product. So marginal product is the additional production for each worker. And then known as the law of diminishing marginal utility. Now you guys probably heard something similar from the previous chapter. Remember we have the law of increasing opportunity cost, law of diminishing marginal utility. They all mean very same thing, right? So this one says law of diminishing marginal productivity. That means the more worker employer hires, the less production you get from each additional worker. So workers become less and less productive as you keep hiring more of them by holding your capital constant. All right, so if you draw the production function, so on the top panel here, so panel, this one here, so on the top panel, you see that our production is increasing as the more and more people you hire. So on the horizontal axis, we have our number of workers. But notice that this rate is going up really quickly, and it looks like it's like flattening out at the end. That means the additional production for each worker is getting smaller, 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 right? So that will show by looking at the bottom panel here, that's your marginal production for trees. So the first person you hire, you can increase production by 4. Next person you hire, second person, you can increase production by 6. And next one is going to be 2, and then 1, and then 0, right? So right after 2 people here, the more people you hire, the less additional output coming from each additional labor. And that's called the law of diminishing marginal productivity. So this is pretty common for most companies. So for most company, they do see an increasing marginal productivity at the beginning, but after a certain point, you're gonna see a decreasing marginal productivity. And then whenever marginal productivity reach to zero, that means your total production is maximized. So somewhere there, when this line become peaked, your total production is maximized. And if you draw this even more, extend it out, eventually this line will go down. So as the more people we hire, you might even see a negative marginal productivity. Okay, so also known as factor payments. So this is how each resources are being paid. So for raw material, you're gonna pay for the raw material price. So buy chicken, buy rice. For capital, you got to pay rent, right? So the buildings, if you rent any equipment, you're gonna pay the rent on it. Labors, you got to pay the wage and salary. If you have borrowed money, you're gonna pay the interest and dividend. And lastly, for the owners, you got to pay for the profit, right? So those will be how you pay for each of the resources. And then for those payment, we have something called a variable cost and fixed cost. So variable cost, this will change depends on how much you produce. Because the more something you produce, the more of labor you're gonna pay for, the more of raw material you're gonna pay for, right? So that's a variable cost. But the fixed cost, that fixed cost will be fixed. It doesn't change. Doesn't matter how much you produce. So think about my business, the rent for the building, that is fixed, right? Because my landlord doesn't care about how many chicken and fries I produce, but my labor, my raw material, right? So the chicken and rice, utilities, those will change, depends on how much chicken and fries I produce. And then your total cost equals to your total fixed cost plus total variable cost. And also known as the average total cost. So that's your total cost divided by quantity. Also known as a marginal cost. Marginal cost is the additional cost for producing each additional unit. The difference is, see the little triangle here? Triangle stands for change. So the changing total cost over changing quantity. All it says is just that if you produce one more good, how much additional cost you have. And next one is our average variable cost. So that's your variable cost divided by the quantity. Now, when you draw your average, when you draw the total cost for the company, so at 0 unit, your total cost is about 160. So remember, total cost equals to your fixed cost plus variable cost. Remember, variable cost, this one changes, depends on how much you produce. So if you're producing 0, so if your quantity is equal to 0, then your variable cost also equal to 0. So at 0 production, if you still have any total cost, that total cost is your fixed cost. Because at 0 production, our variable cost equal to 0. So if I don't produce any chicken and fried rice, I don't pay any money for chicken and rice, right? So, but if I still have any cost, let's say my rent, that rent is my fixed cost. Now, when you draw your average total cost, your average variable cost, and maybe also your marginal cost, your marginal cost will be going down first and then going up. So this portion, when the marginal cost is going up, that's your diminishing marginal productivity, right? So as the more and more companies producing, the more additional costs that's associated with each production. And also notice that whenever the marginal cost curve is intersecting with our ATC or APC, that's the lowest point of both of the curve there, right? So that's the lowest point of average variable cost and also lowest point of the average total cost. All right, next known as the average profit. So that's also known as a profit margin. So for those of you guys who are studying accounting, you're gonna hear this a lot, profit margin. So that's your price minus your average total cost. If the market price is more than average cost, that means the company is making a profit. And if your market price is less than average total cost, then the company is losing money. Now, in the long run, all the factors become variable. So in the long run, everything becomes flexible. So remember that building of mine, the place I rent for my chicken fried rice business, that's also becoming variable because I can expand my operation in the long run. Right? So give me 5, 6, 7 years, I can rent a bigger space, right? So that rent is also becoming variable. Also known as a production technology. So the different alternative method of combining input to produce output. So in the long run, company will choose whichever combination of input is most efficient for the production. So in the long run, there is something called an economy of scale. That this happens whenever a company produce more, they might see a lower average total cost. So as the company produce more and more and more, the average total cost will be decreasing. So it's becoming more efficient to produce more good. So for example, let's suppose we have a small factory produce 1,000 alarm clock, and with all the overhead, with all the rent, with all the cost for managers, then the cost for each clock might be $12. But if you're big enough, so if you produce 2,000 alarm clock, then the cost of each one will be only $8, and then produce 5,000 alarm clock, then cost of each one might be just $4. And the reason why you see this decreasing average total cost is that some of the cost can be spread out among different productions. So again, that fixed cost. So fixed cost can be spread out between all your productions. So the more you produce, the lower the per unit fixed cost is. That's why sometimes it's more efficient for a company to expand to have a lower average total cost. And that is called an economy of scale. Now, also known as a long run average cost curve. So this one shows you the lowest possible average cost production, including all the input for production. Now, the short run average cost curve, that will show you only the average total cost curve in the short run, right? So in the short run, you still, again, remember the difference between short and long run. In the long run, everything's all flexible. In the short run, you still have fixed cost and variable cost. Okay, so when you draw this long run average cost curve, then there are different sections. So in the very beginning, when the long run average cost curve is going down, that's called the economy of scale. That means it's efficient for companies to produce more and more good. The more good they produce, the cheaper the average cost is. And this flat section, that's called a constant return to scale. That means for this section of the average cost curve, the more you produce, your average cost doesn't change. And then at the last portion there, that's called a diseconomy scale. That means the more of something produced, the even more the average variable cost is. So it's an increase in average variable cost, average total cost. So for most companies, they go through this structure. So at the very beginning, company become more efficient when they produce more good. But after a certain point, company lose efficiency. So the more they produce, the even higher the average cost is. So those are called the economy of scale, constant return of scale, and lastly, the diseconomy scale. All right, so the shape of the long run average cost curve also can imply for different factors. So this can imply for how many companies can join in the industry. So the more companies join the industry, the more stretched out your long run supply curve is, your long run average total cost is. It can also depends on different size of each company. So sometimes just because you have more company doesn't mean that each company can produce more good, because some company can just expand their own production. We have two long-run average cost curve here. So on the panel A, we have a clear lowest production point. So for panel A, then company will choose to produce at point R, because at point R, we have the lowest cost. Anywhere besides that, you're going to see a higher cost. So companies are most competitive when they're producing at 10,000 units, because anything other than that, they're going to see a higher cost and become less competitive. In panel B, we actually see a range of this lowest production cost. So anywhere from 5,000 to 20,000. So companies are very competitive in this section, But again, anywhere besides the section, then company will see a higher average variable cost, average total cost. So they become less competitive. Okay, so as when the market is very competitive, companies want to be here, and companies want to be here, this section. Okay, all right, guys. So that's it for this chapter. Any question, let me know, and I will see you for next chapter. All right, bye bye.